It happens to everyone unless you know exactly how to undo it. It's also something that you're forced into. If I were to guess how many people fall into this mistake, I would guess somewhere around 90 to 95% of people fall into this mistake. So it's a pretty big deal. As an owner of a wealth management firm that specializes in RSUs, I'm going to show you the 7 biggest mistakes that are keeping you poor, ruining your RSUs, and causing you to fail financially at your goals, including the biggest offenders of double taxation and chasing after a tax benefit that doesn't exist. Let me show you. And because this mistake of chasing after this non-existing and non-exclusive tax benefit that doesn't exist is more common, I'm going to start by addressing that by pulling up my whiteboard and showing you exactly how the taxation of RSUs work. So when you're granted an RSU, there is no tax ramification to that. You're not the owner of stock yet, you're the owner of a unit. That's what the U in RSU stands for, but you do pay tax as soon as you do become an owner of the company stock. So this dot right here is going to represent when your shares vest. And please note that the y-axis represents dollar amounts, and this is a clock representing time. So over time, up and to the right would just mean that over time your money is growing. So when your RSUs vest, represented by that point there, you owe ordinary income tax on that money. And I'm going to compare this to just a regular stock. So if you were to go and buy XYZ company, let's look at the point that you become an owner of company stock. And you become an owner of company stock at that point when you decide to purchase these shares. Now let's think about how this money got there. Where did you use that? Where did you get that money to buy the company stock? Well, you probably got it from your bank account, and the money in your bank account got there from being taxed through your salary, most likely. So this money has been taxed that you're now using to purchase stock. This money has now been taxed through these RSU. This stock has now been taxed. And so there is no difference up to this point as far as the taxation between RSUs and just buying any regular stock. So let's take this to the next level. Let's say that these shares grow to $25 when they were originally $10. So $10 and it grows to $25. Let's take a look at the tax benefit or existing tax ramifications here if you were to sell at $25. So in the case of RSUs, it depends on how long you hold the shares after vesting. So I'm going to put short term, or ST for short term, LT for long term. You're going to have a short term or long term, again depending on the holding period, gain of $15. You have a gain of $15 over here. Now let's look at stock. It's going to be treated the exact same. It's either a short term or a long term, again depending on that holding period, gain of $15. So this right here just proves to you that there is no tax benefit that's exclusive to RSUs. And you may be saying, well, if I hold on to my RSUs, and I can get the long-term capital gains treatment. And I would respond by saying, yeah, you can get the exact same tax treatment, long-term capital gains, buying a regular stock, or what I would suggest is getting into a low-cost, globally diversified portfolio, which is much safer than concentrating all of your wealth into a single stock. But don't get too comfortable, because this is not the last mistake that people make. So this next mistake happens when you're actually too smart for your own good. So a lot of people, once they get a few ideas as far as how to tax plan, they then try to apply it to their situation, and that's when things can get messy. So in this situation, what happens with RSUs when they vest is that's reported as ordinary income, and it flows through just like your W-2 does in the exact same box on your tax return. And so they think to themselves, oh, I've got some stock over here that I can sell for a loss. I can then use that loss to write off the RSU gains. And there is a little bit of truth to that, but you just need to make sure that you fully understand how it actually works, because when you have losses, that's in a completely different area of the tax code than where your income goes. So for example, capital gains and losses, those go on Form 8949 and Schedule D. That does not touch your income. Only if you have an excess, once you offset the capital gains and losses, if you have an excess $3,000 worth of losses, that's when you can write it off against RSUs. So if you have $50,000 worth of losses that you're expecting to write off completely against $50,000 worth of RSUs vesting, just know that that's not actually how it works. I know this can seem like a lot, so I created a free RSU cheat sheet available for download in the description. You'll also want to hit the subscribe button so that you can watch my video on how to retire early off of RSUs. This mistake actually has a second mistake built into it. And as I share what the mistake is, you're going to realize, oh, that applies to me. I made that mistake. And then you're going to take some compensating action to try and fix it, which is also a mistake. So make sure that you're working with a professional on this one, and please don't take immediate action as soon as I tell you what the mistake is. The unfortunate thing about this next mistake is you don't actually have to take action to make this mistake. It happens naturally. If you don't take any action, it happens. So there's some irony here, as your company is trying to give you a benefit through giving you RSUs, yet it can actually become quite detrimental to your future. So if you think about it, as your RSUs vest, company stock is just hitting your portfolio and it's just accruing there. And as more and more RSUs vest, a larger and larger portion of your net worth is going into your company. And therein lies the problem. Obviously, there's going to be rules of thumb around how much of your portfolio should be in individual stocks, especially your company stock, where you're currently getting your income from. So, I mean, it really just depends on the situation, but I would prefer a much lower number, much lower than 10%, maybe 5% of your net worth tied up into company stock. And that just really depends on one's risk tolerance and capacity. You're very familiar with the whole premise of not putting all of your eggs into one basket. And there's a reason for that. And that's so that you don't have to suffer the consequences of having your net worth disappear if your company stock isn't performing well. So that's the unfortunate thing about it, is that you don't have to take any action. It just happens automatically. And so you have to take action to avoid this mistake. Something that I suggest all my clients do is, as soon as their RSUs vest, is to just sell all of their RSUs immediately. And even if they're planning on buying or holding the company stock, I still suggest this. And the reason being is it's kind of a bit of a behavioral and psychological trick that forces employees to think twice before they buy back into their stock. And we've already addressed that there is no tax benefit exclusive to RSUs. So as soon as your RSUs vest, you pay taxes on them, regardless of what your intentions are. If you're holding or buying or selling, doesn't matter, you pay taxes, ordinary income on that money as soon as it vests. So you might as well just sell it. You're welcome to buy back in if it makes sense from a diversification standpoint, like if you, or from a risk tolerance and capacity standpoint, you're welcome to buy back in. But if you were to sell as soon as it vests, you now have a behavioral barrier that separates you from making silly decisions of overconcentration. So while it may make sense, it's just a little trick that doesn't actually have a tax impact or a financial impact other than helping protect you from yourself. So if you're drinking too much of the company Kool-Aid and you are wanting to basically own all your net worth into your company stock, then that gets a little bit risky. So the problem here is that if you are planning on holding and you sell, let's say that you don't sell immediately and you sell 15 days after it vests. So you pay stock, or you pay taxes as soon as it vests. 15 days later, there's now a loss cooked into your RSUs, or maybe it's 30 days later. There's something called the wash sale rule that disallows people from writing losses off if they had purchased that stock within the last 30 days. So you can't actually purchase the stock or even have RSUs vest within 30 days of you writing losses off on that same stock. So that's just something that you have to be very careful of, is ensuring that you're not going back and buying that stock that you just wrote off for a loss, and you're also not having RSUs vesting within that time frame. And to give you an exact number here, it's actually 30 days before you write the loss off. The day you write the loss off and 30 days after you write that loss off, you cannot buy the stock and you cannot have RSUs vesting during that time frame. So you have to be really careful, and this is why I really suggest strongly working with a financial professional so that you're not cutting it close, and that if you have losses to write off, that you're actually able to write those off and you're not just doing it and the IRS disallowing it later. So hopefully that helps, but that's still only part of the equation. Okay, so you're gonna start to notice a pattern here, which is that you don't oftentimes have to take action in order for this mistake to happen. And this mistake is no different. There are factors that are outside of your control that make the mistake, and then you are left to pay the bill. And this is no different in that you are getting taxed twice, and you don't have any say in it unless you know what measures to take, and then you have to be proactive to fix this mistake. And it's pretty common, and the double taxation happens when your RSUs vest. We've already discussed how that's reported as W-2 income. That flows through your W-2 alongside your salary. So you pay income tax, ordinary income tax on that amount that vested. So you've paid tax on it once already. And that's all good and fine, besides maybe a little quick bonus mistake that I'll add here. You need to make sure that your withholdings, that your company's withholding, aligns with how much you actually need to be withholding. Otherwise, you're gonna have some surprise tax bill at the end that you may not be able to afford. But that's a discussion for another day. That's the first time that you're paying tax. The second time that you're paying tax is when you sell your broker. For example, maybe it's Schwab, maybe it's E-Trade, maybe it's Morgan Stanley or Carta. They are going to file what's called a Form 1099-B, which is reporting that sale. And the problem exists is when they say that your cost basis is $0, when in reality, you have a cost basis that's much higher than $0 because you just paid taxes on it on your W-2 income. So that's where the problem exists, is that you've paid taxes already on your W-2, and then on your Form 1099-B, they are reporting that you have yet to pay taxes on it, and so they force you to pay taxes on it again. But if you take the proactive action of ensuring that your cost basis is the same, you can make an adjustment on the supplemental form to 1099-B, which will allow you to increase your cost basis to the appropriate amount and thereby avoid paying taxes twice on the same RSUs. But don't get too comfortable, because there are other mistakes just beyond double taxation. So this next mistake has just as much of an impact on your personal finances as the previous mistakes, but it also is a little different in that it's much more emotional and touchy-feely, and here's what I mean by that. So I've heard it said that your expectations are an appointment for disappointment. And so as you set high expectations, you're bound eventually to become disappointed. Now, how does that apply to your RSUs? Well, when people start to receive RSUs, let's say that they're earning $100,000 in salary and $50,000 worth in RSUs vesting each year. They then assume that they're earning $150,000 a year and adjust their lifestyle, and the stock isn't something that's going to stay put where it's at. Stock prices fluctuate. So let's say it's no longer $50,000 this year and it jumps down to $25,000. So now you've got this high lifestyle that you've come to expect, and you're trying to keep it up, but your RSUs aren't very static. They're going to move, they're going to fluctuate. So that really comes back to us analyzing what are our values and goals, what's our risk tolerance and risk capacity. Then let's look at the financial merit, like diversification and things like that, and then we can get into taxes. And we need to make sure that we have that priority of what comes first, because if we don't, we tend to make mistakes. So for example, let me just give you an example. If you were to focus on the financial aspect of RSUs, you have then mentally anchored to that $50,000 number. Well, guess what? You're going to be pretty disappointed when the stock price adjusts. And we just want to make sure that we're actually planning around your values and goals. So we're not escalating our lifestyle and increasing our expenses for the sole purpose of spending that $50,000. We want to make sure that it aligns with what we're actually trying to do with our time and with our money. So please don't make that mistake. But here's the next mistake that you should definitely avoid. I found this mistake to also plague individuals because it's really easy to forget about this mistake. So many people are planning their exits from their company and forget completely about their RSUs. They're just focused on their job interview at the next company that they're moving to, or what they're going to do in retirement. And as they are leaving, they forget to take a peek at when their RSUs actually vest and how much is actually vesting. And this creates a problem because you want to try and optimize as best as you can to stay at the company until your next big vest. Now, One needs to measure against kind of your insides and what your gut tells you. Maybe you're leaving the company because it's emotionally draining. And my suggestion is, if it's that emotionally draining, please don't continue to stay at the company just to get RSUs. We want to optimize for your physical and emotional and spiritual and mental health over financial health. So you're going to have to be the judge on this one and make the call on if it's worth staying till the next vesting date. But please, before you leave, just double check, because the mistake that you don't want to make is leaving a day early or a week early or a month early if you're able and willing to stay, especially if there's going to be a big payout coming up. Okay, so I've actually been lying to you. I said that I was going to give you 7 mistakes. I'm actually going to give you 3 bonus mistakes after I introduced to you this video, which is how to retire early off of RSUs. Bonus mistake number 1 is thinking that you can perfectly offset the risk of your RSUs by using complex calls and puts, which is actually constructive receipt, which is a taxable event. The second bonus mistake is thinking that you can move from a very tax-heavy state, such as California, to tax-free Texas and not pay income tax on a state level by moving to a tax-free state. And the problem with that is that states like California have something called a trailing tax liability. And what they say is if those RSUs vested in our state, then that income belongs to our state. So you will still owe income even if you move to a tax-free state. The third bonus mistake is the 83B election, which people think applies to RSUs. It only applies to restricted stock, not restricted stock units.